Okay, so thank you again to everyone for logging on to our spring webinar series. This is part 2 of 3 that we will be doing. And today we are going to cover market updates. We are also going to cover the Secure Act. And we are also going to sprinkle in a little bit of information about the most recent act that was passed, which is called the CARES Act. So we can't keep up with all this stuff that's happening. So your wealth advisor team is, we are all pictured here on the, which I think will be the same for your viewing, is all on the right hand side here. And so I'll be introducing them as we go. So today we're going to talk about who we are. Again, well, I just went over that. And then also some next steps of what to think about. You know, in these times, it's normal to think that we should be doing something. And so we are going to talk about some strategies and opportunities that we feel are appropriate to look to during these times. We're also going to be throwing a lot of information at you. So I would encourage you just to take it in, maybe write some notes. If you have questions, please jot them down. We may have time for questions at the end. If you just want to go ahead, there is a Q&A function in the navigation bar at the bottom. So you could put in some questions as we go as well, and we'll kind of field if we want to answer them at that time or at the end. And let's get started here. So first, I'm going to introduce Chandran Rajaratnam. He is our president and wealth advisor. He's got amazing executive experience. You can see by the screen of some of the major companies that he's worked for. We have been honored with his presence here at our company, and he has really helped us grow and bringing that management expertise to our team. And I also want to highlight that in 2019, he wrote a book called Catch the Arrows. You can find it on Amazon. And we have integrated those principles into our business and working with our clients. And we believe everyone, as he talks about in his book, are leaders. So Chandran, I'm going to turn it over to you.
Thank you, Julia. That's a very lovely introduction. Now it's my turn to introduce you, Julia. Julia Carlson, our CEO and founder, started this business 20 years ago. Got this lovely family. Not only does she start a business, run it, and make it successful in 20 years, she's also raises a husband and 3 kids. That's the way it works.
That's good.
And if you go onto our website, you'll see all of the accolades she's received. Top Women Advisor, Top 40 Under 40, which unfortunately she can't win again. There's some technical reason. I think it's called age. But more importantly, back in 2008, she was appointed a Dave Ramsey endorsed provider, and in 2016, as Dave Ramsey changed the program, it became a Smart Investor Pro. So you can see all of her accomplishments. But as I said before, 20 years ago, Julia founded this company. We're an independent wealth management firm that basically provides customized planning solutions for all individuals, families, business executives, and businesses as well. I think one of the key things I want to tell you is that there's apparently something like 212,000 financial advisors in the United States. And I'm going to say half of them might be able to do almost as good a job as we do in handling our customers' investments and portfolios. But very few, if any, have this type of focus we do, which is to create a plan for your dreams and inspire you to pursue financial freedom. More importantly, our commitment is to care deeply about you and your financial life. And that's more important to us than anything else that we can do, because it's about you, your life, your retirement, and what you want to get done. For example, we have no minimums, because whoever comes to us who wants help, young people creating a Roth IRA, et cetera, we feel privileged to be able to help them. we run our company based on some core values, which we're willing to actually go out of business before we violate. We'll never violate these, which is to treat all people with respect, never compromise their integrity, have you, the customer, be delighted, not just satisfied, but delighted. And then one thing you'll notice if you go to our website, and as you can see on the right side, we have all our wealth advisors, but the whole company is a team, and we embrace a culture of teamwork to help our clients be delighted. We have 5 locations, actually, as of April 26th. There will be 6, including Portland, with 5 wealth advisors, full fiduciaries, wealth advisors, and 8 support staff. And we're growing. So, and our broker dealer, Julia will talk about later, is LPL Financial, the largest independent broker dealer in the country. And we're privileged to be in the top 1% of the advisors at LPL Financial, based on your customer support and making us successful over the years. This is our team as of today. And as you can see, one of the key things about our team is that we're good looking, which, as you know, is a key criteria for handling finances, right? And then if you go to, when you look at our wealth advisors, there's 5 of them now. You got DJ to my right on the picture, myself, Julia, Jason, and Matt. And Matt there on the left is our newest wealth advisor. He's an import from Pennsylvania. We got his accent cleared up, so he sounds like somebody from Walport now. And we're with over 18 years of experience in the business. We are privileged to have him help our customers as part of the team.
Thank you. Thanks for coming
If I could go to our vice president and wealth advisor is Jason. Jason's a fixture in Corvallis, the town of Corvallis. He and his family have been there for quite a while, and is if you ever go to Corvallis Parks on the website, you'll see his family is a spokes family for that park. He's a certified financial planner. He was our Ramsey Solutions Master Financial Coach, 2012. He's had lots of corporate experience, and we're privileged to have him now with us for almost 7 years, helping run the operations of the company and be a full fiduciary wealth advisor as well. And I'm going to turn it over to Jason for market updates. Jason, over to you.
Awesome. Thank you for that, Chandran. Appreciate it. Yes, we've got some market updates to do. It's amazing what's changed even since the last time we chatted a few weeks ago. This is by far the deepest recession that we've seen. We were down 35%. Which is pretty significant. And if you look, we're still down about 15% from the peak of things. As a lot of you know, there's been about 22 million people in the US that have filed for unemployment, which is pretty significant. The weird caveat in all of this, though, is that stocks just had a 15-day rally, the largest rally since 1933. So it's like you've got these deep drops and then you've got these high peaks here. So we want to take a look at a few of these things. We want to look at a little bit of the history. And if we look at this next slide here, it has a tendency, let me say it right. History has a tendency to, it doesn't repeat itself exactly, but it has a tendency to rhyme. So I heard that somewhere and just thought that was a great way to look at it. So even looking at this chart, you're looking at the large US companies, which is noted by the S&P 500, the top 500 large companies over the past 93 years. And if you look at it, there's almost a pattern there, but not exactly perfect. You can see the red downs. There's probably about, 9 of those there. And they're fairly short if you look at them in comparison to the blue up periods. So when you're looking at, a 20% drop, it's generally followed pretty closely by a large uptick that lasts pretty significantly most of the time. So deep recession, likely to be a increase. So question is, are we headed for a recession? Clear answer, we're already in one, so yes. Now to kind of mix it up a little bit, we wanted to do a little poll question to find out what your thoughts are on how the S&P 500, so you're talking the large US companies, are going to end the calendar year. So when we're looking at the end of 2020, what do you think is going to happen? So just take a moment. There should have been a poll that pops up, and you've got choices to select. This is going to be live, so we'll get to see everyone's data from what's being sent out. Do you think the market will be down more than 20%? Do you think it will be down 10 to 20% or less than 10%? Or maybe you think it's going to be up. And if so, do you think it'll be up less than 5%? Between 5 and 10, or more than 10%? So just take a quick moment, click your selection, and press submit.
Ooh, we're getting the results here. Interesting. Can you see the results on your side, Jason?
No.
No, all right. So I guess I'll have.
Is there a way to share them? No?
It doesn't look like it.
Okay.
So we've got almost 75% of us have put in their vote. So we'll give it a little bit more time. Just do your best educated guess on how you feel now about the markets.
You're going to start predicting the future. We do have that ability, right? We can make a good guess.
Yes. Okay, so I think overall here, almost all of us have voted. There's a couple that may not know exactly how to respond to it, but the most, so we have 28% of us think that the market will be down 10 to 20% at the end of the year.
Okay.
Which is 7 months away.
Right.
And then second place is the market will be down 10% or less. That's 20% of us. The market will be up less than 5% is third place.
Okay. Oh, good.
And then actually the market will be up 5 to 10% and up 10% tie the next two. So
okay.
So not very many think that we will be down more than 20%. So there's more optimists here than.
Of course, I put in my vote, so I'm skewing it a little bit.
What was your vote? What do you think, Jason?
Well, my thought is that it will be up to 5%.
Up to, okay.
Mm-hmm. So that was mine. So let's look at this next slide, which actually compares the deep drop to what the market actually ends at when you're looking back at the calendar year. So this one, it's represented by those orangish yellow bars. That's the most that it dropped during the year. We're looking at the S&P 500. And then the blue bars show what the actual return was for that calendar year. So let's take, remember we said it's been a 35% drop this year. So that happened in close, not exactly, in 1987. And then there's another one in 2002. So let's look at in 87, even though it had dropped 34%, we actually ended 1987 with a 2% gain, which is amazing, right?
Mm-hmm.
And then if we look back at 2002, we can see that market dropped. We could clearly see there was a 34% drop that year. Now we didn't quite come out of it that year, but we got from knee deep to to ankle deep, right? Mm-hmm. So ended the year that year down 23%. Now, of course, if you look at subsequent years, there is a gain there, But there's never been a time, we're only looking at a 40-year history right here, but there's never been a time when we ended the year at the lowest point that it ever was. So for the markets to be down 34% and stay there is highly unlikely, because what happens is things go down and then they come back up. So I have a little bit more optimism knowing the data and what we're seeing now. There's actually more optimism in the market than we're even seeing reported. So that gives confidence, and we'll talk about some of those things that are happening here shortly, of things going back up. The other thing to note is we're looking at the past 40 years here. The average over all that time each year has been a 14% return. Now, when I'm looking at these numbers, there's only one actual year where it shows an actual 14% return. That was in 06. So you will have some downs, you will have some ups, but over 40 years, if you can average a 14% return, that's a pretty decent return. Now, not everyone has 40 years, and that's why we do planning and help you be strategic about what you're doing. But this gives a good indication that even though markets are volatile, things go down, they do come back up. If it doesn't come back up, we've got bigger problems, and we're all very concerned. So none of that here, because we've even seen an uptick, as I said before already. Okay, let's look at the next one. This is taking a little bit longer view. The last one we looked at 40 years. Now let's look at the past 93 of your large US companies. What has happened after we've seen a decline of 10% or more? Now, we just did a 35% drop, right? What does the next year look like on average over the past 93 years? Well, the next year, 1 year look back or look ahead after that was an 11% gain in your large US companies. That's pretty significant. So if you hold on and you just have a year, on average, you're going to return 11.3% looking back over our history. And then the numbers, they look lower, but it's actually a better number. If you can look ahead 3 years on average and get 10% return for the next 3 years, that's also significant. And 5 years, you're almost at 10% every year on average for those 5 years. So those are great returns. Those are great numbers. So let's talk a little bit more about, because not everyone's going to be super aggressive in the market. What about if we had a more balanced portfolio? So we had mostly stocks, about 60% stocks, and then some bonds to kind of help with income. And so this is where a lot of our clients are who are retiring or getting close to that point. They're in a portfolio more like this. Looking back at 7 significant times where we saw a downturn, that first one in 1987, the stock market crash. This is showing 1 year, 3 year, and 5 year returns after that time period. So again, there's only a couple times on here where a major market change where a year later you saw a decline. That was savings and loan in 89 and then the terrorist attacks in 01. But every other time here, the first year after, you're up. And look at that stock market crash of 87. Our clients talk about that. Like, I remember when that happened. But if you had a balanced portfolio there, a 19% return a year later, that's really good. And then if you look at 5 years later, you're averaging a 15% return. That's significant. And you're not even in all stocks in this portfolio. And if we also look at, let's look at the terrorist attacks, because that's another one that people remember. First year down, but then 5 years on average, that 81%, it's about a 16% return per year for the next 5 years. Pretty good. Lehman Brothers bankruptcy, we all remember 2008. Terrible. The economy, it just took so long to recover. But look what happened in your accounts. 4% return over the first year, and then a 47% return over 5 years. That's an average of 9.4% per year. And so this is why we help our clients stay the course, because when you've got a portfolio that's set up for you, specific for you, you don't let these little blips and dips and panics and concerns change you or sway you from the course, but you stay invested in, and you keep going. When we think about the markets, they are really forward-looking. They're not wondering what happened. They're talking about what's going on next, and that's why we've seen some of this gain, because the Fed has infused money and capital into it. We've seen cases start to go down with coronavirus. Deaths start to go down, or maybe stabilize, I guess it would be. So there's confidence that's starting to build. There's even news of a few states starting to, get back to the new normal, but open up some restaurants, some stores, things like that. So those signs of good things to come are on the horizon. And that's why it helps with the markets, and you'll see an uptick quicker than you will in terms of the economy going up. So confidence is coming back. Big banks are doing well, which helps. Now in 2008, that wasn't the case. So we're in a slightly different scenario here. But there's no reason why this sharp drop will not also be a sharp climb back up. And we've seen some of that. We're also seeing indicators that there probably won't be another drop, like significant drop again. It could happen. It depends on what's happening in terms of reporting and the global crisis. But likely we'll see things climb out of here pretty quick, which is great. So let's talk a little bit about our emotions, because I know that can kind of get to us. Like, I see these cases, I see the deaths, I see the global toll and all this stuff. If we look at this next slide here, we can see that we're kind of in that bottom part there where it says fear. And what we're seeing is, at least on the market side, you're starting to see that optimism, and eventually our emotions will follow that when things start to come back even more, and we say, hey, let's get invested again. But a lot of that fear is still around because there's a lot of unknown. When will the country reopen? When will our states get back to normal? And that's a normal part of our lives, is that we have emotions, but we don't want to make decisions that are driven by emotions. So fear would tell you right now, uh-oh, there could be another drop, let's sell. But if that's not part of your plan, then that's not a good thing to do. And then the other side, if you see the optimism, it goes to elation, like you're super excited when everything's high. And then it's like, hey, let's buy things. But really, from a market perspective, that may be the time to sell some of those things that are high and buy some things that are on sale. And of course, you can see the pattern. It's very cyclical. So we get the nervousness again, the jitters, we go into fear. But these things come back. So it's good to have someone that you're working with, like our team, who's looking out for this for you and who's helping you make decisions that are most beneficial to your life. So we're not going to let fear drive our train, are we? We're going to stay the course, and we're optimistic that things are going to open. Last time I said in the next 1 to 2 weeks, but apparently not. Maybe 1 to 2 months is what I'll say now. Much more of a slower reopening. So that is a quick market update for you. And if you do have questions or things you'd like to we may even be able to address some of them today, you can put them in the Q&A box, or there'll be a time at the end where you'll be able to email those in.
Yeah, and I just want to make a comment, thank you, Jason, about the alternative, because a lot of clients that we talk to, they have that fear, and which is really driven by the uncertainty out there. And like you said, with the markets being forward looking, even though the unemployment numbers are bad, that certainty, even though the earnings, that we're in earnings season right now, and And that is providing certainty to the depth of this recession, and then giving guidance to what each company is expecting for the future. So those are the things that are really driving this market. And boy, what a difference 2 weeks makes, right? Yeah. From where we were at to now. And the alternative, unfortunately, the alternative is if you sold investments at these levels, you lock in the losses, you lose the ability to have them recover and not lock in the losses. And then the alternative is cash. And interest rates right now are at 0. And it's interesting that after 2008, 2009, when the Fed lowered rates to, low levels, not to this low, but low levels, guess how many years it took for the rates to come back to, 3-4%? I was surprised. It was actually in 2015.
Wow.
So we could be at these low interest rates for the next several years. And I would say, okay, where is that opportunity? It's not in cash because you won't earn anything. It's maybe taking advantage of refinancing your mortgage, your debt, student loans, those things that we can take advantage of and do something when the rates are so low. But going to cash and not having the ability to recover like we've seen in just the last 2 weeks, is a mistake.
Yeah, well said.
All right. So I am going to transition us here. Again, if you have any questions about markets and you would like to ask, just put them in the Q&A and we will pick them up at the end. So the Secure Act. So first, what does Secure Act, what is it an acronym for? Setting every community up for retirement enhancement. Now, this was an act that came into play in very late, like December, I think 27th or 28th of the end of last year. But it feels like we've already kind of forgotten about it because of all of this coronavirus. And now we have something called the CARES Act, which is, I was going to tell you the acronym for that, Coronavirus Aid, Relief, and Economic Security Act. So that is the one that was just recently passed. I think with all the different stimulus packages, it's currently about $2.5 trillion of stimulus into the economy. I know a lot of our clients are getting those stimulus checks. And that, again, the hope of that is that it goes back into the economy to support it. But let's talk about the specifics here for the Secure Act. We're going to break it down and kind of give you the 5 key changes. And DJ, hello, do you want to wave, DJ?
Hello.
He is going to help me unfold these 5 key changes about the Secure Act. DJ has been with us for over 5 years now. He graduated from the University of Oregon, a big Ducks fan.
All right, I'll throw the O up for you, Julia.
And there's pictured with Oliver, his now 4-year-old. I think he was a little younger then. But we're just thrilled to have DJ on our team. He is one of our wealth advisors. And he is going to give us some knowledge here, again, in these 5 key areas. So why don't you kick us off with number 1?
All righty. And good afternoon, everybody. Tune in next time. I'm going to get an updated picture for that so everybody can see how he really looks. He's looking scruffy there. Okay, so this first change relates to required minimum distributions, or RMDs as we call them. So an RMD is the minimum amount you must withdraw from your retirement account each year once you hit a certain age. So the government's basically saying, we've let you defer taxes long enough, we want to collect our tax revenue. So they've changed this from age 70.5 to 72. Now, it's actually the year that you turn RMD age that you have to take that. So you have the full year in the year that you turn 70.5 before, now it's 72. So basically, for that first year, though, they give you an extension. So they allow you to take your RMD up until tax time just for that first year. They like to make things confusing. This is just another one of those things. But after that first year, you do have to take it by December 31st each year going forward. So it's important to note that this change only applies to those who turn 70.5 in 2020 or later. Okay, so if you turn 70.5 in 2019 or before that, you must continue with your RMD. So regardless of this change, the most important thing to remember is that you have to take it every single year. So you can take more than your requirement, but there's a 50% penalty if you do not take enough. So really important that you don't miss this. And we actually handle this for all of our clients so that they don't have to worry about that. Now, through the CARE Act, which is that recent, stimulus package, they've waived RMDs for 2020. So everybody can opt out this year, okay?
And I also want to mention, if you have an inherited IRA or a beneficiary IRA, those required minimum distributions have been waived for 2020 as well.
Thank you, Julia. Okay, so the next topic is for qualified charitable distributions, or QCDs. So this basically allows you to donate your RMD to a charity of your choice and avoid paying the tax. Now, this is still available at age 70.5. So even if your RMD is now 72, but you turn 70.5 this year in 2020, you can do this. Now you can do more than your RMD, but no more than 100,000. That is the cap. Now, what's great about this is that you don't have to itemize, and you can still receive that full standard deduction while saving or satisfying your charitable intents, right? So it's pretty cool. Next slide, please. We'll look at an example of this. So here's just, showing how it affects your taxes and saving you money. So that first column, without the QCD, the $10,000 distribution is included in taxable income there. You can see that. Now, with the QCD, it is not included in taxable income. And if you look at the bottom there, they're actually saving approximately $2,200 if you were in the 22% tax bracket. So again, it's direct savings, and you're actually helping if that's something that you believe in. So another potential benefit is that the income won't be included in calculating whether Social Security is taxable. So again, you can potentially meet all of your RMD requirements, satisfy your charitable intents, all while saving money on taxes. Pretty good to me. Mm-hmm. All right, we'll go to that next slide. So the third one, I really like this one, is the ability to contribute to traditional IRAs for longer. So previously, once you were at RMD age, you could no longer make contributions to a traditional IRA. This was actually the only retirement account for which contributions were not permitted due to older age. Now, beginning in 2020, individuals of any age may contribute to a traditional IRA as long as they or their spouse has earned income. So you do have to be working and earning income to be able to contribute to retirement accounts, and that has not changed with this. So let's say you are at RMD age, you're still working, now you can keep contributing to this type of account, but you'll still have to take your RMD for that year. So if you're 75, you're a workaholic, you're adding to your traditional IRA, you will still have to take money out as well. So it'll be money going in and out all in the same year, but it would offset it basically. So, and then that, those dollars would then continue to grow on a tax deferred basis for your future, or possibly for beneficiaries. So another update with the CARE Act is they've extended making contributions up until July 15th for 2019. So you always have up until tax day to make your contributions for the previous year. And that is now July 15th, and you can continue to make your contributions for the previous year. So let us know if you haven't done that and you want to chat about that. We can help you get that set up.
Excellent. Thank you, DJ. All right, so let's switch to business owners, some incentives for business owners that came out of the Secure Act was that small businesses can now get a bigger tax credit for establishing a retirement plan for their workers. So again, this Secure Act was to enhance retirement savings for every community. So what they are incenting here is that business owners do set up these savings plans for employees. So if you are a business owner and you want more details on that, I don't want to go over all the specifics, but please reach out to us and we can help you determine what that credit would be for your company. And then the CARES Act was, there was a whole piece of the CARES Act that was dedicated to small business. Small businesses have been hugely disrupted during this COVID-19, and a lot of the stimulus was dedicated to those business owners to keep really people at work, to be able to avoid having to lay off their employees. And there was a couple, I'm just going to highlight a couple different programs. The first one available for business owners is what's called the Economic Injury Disaster Loan. They refer to that as EIDL. If you go to sba.gov, you will be able to see there's a COVID-19 resource right there. You can click on that. If you are an independent contractor, a sole proprietor, an LLC, an S Corp, a partnership, a corporation, all of those are covered under this plan. And the first 10,000 is a grant as long as you use that money for things like payroll, for mortgage interest, for rent. There's some, again, there are some specifics that you want to know about these programs, but that is one option. Another option, which is called the PPP, or Paycheck Protection Program, it had almost $350 billion allocated to this, which has all been used. I'm sure you've heard about it in the news, but they are now currently, maybe already approved, working on adding additional funding for this program. And so I would encourage you, if you are a business owner and you have been impacted by COVID-19, and the impact means uncertainty, your business has become uncertain due to this, then that program, the PPP, has to be applied with your local banker. So I have heard that it's best to go with the current bank that you have a relationship with, as long as they are SBA approved. And a lot of banks have scrambled to get this approval. And so you really want to work with your banker to go through that process. So even though the first amount was allocated, I would encourage everyone to, or we would encourage everyone to get in line, get your application in there, and it's pretty streamlined, pretty simple to complete. But we are here to help any of our business owner clients that need help with that. We do know kind of the details behind that. So those are the two. Also, this is the first time in history that independent contractors, sole proprietors, self-employed individuals can qualify for unemployment insurance. So I would encourage everyone to, if you are a sole proprietor and your income has been affected, to go apply for those benefits. Keep applying every week, and you should be getting that benefit. So those are the main things for business owners. Again, if you have any questions, put them in the Q&A and we can come back to this at the end. Okay, the fifth key change to the Secure Act, which we think is like the big one, because we are very passionate about helping our clients build their legacy and then move that legacy to the next generation. So I'm sure you've heard all of us talk about the concept of what we would refer to as a stretch IRA. And what this means is that it allowed for the beneficiaries, namely children of the IRA owner, that they were able to take out distributions from an inherited IRA, inherited account, over the children's lifetime, which could be 50, 60, 70 years that they can make these payments. And the benefit of that is it stretches it out, and it also stretches out the tax liability, because most of this money is in pre-tax bucket, or money that's never been taxed. So you maybe saved it in your 401k, your retirement plan, you got the deduction when you put the money in, but then you've never paid taxes on it. So the idea of stretching that out over time was very attractive. And now that has been limited to 10 years of the original owner's death. And so those stretch provisions have gone away. There are some exceptions, but this also applies to all Roth IRAs, 401ks, 403bs, any type of retirement account out there. And so it pretty much states that if you have to, the beneficiary of that account has to use that money up within 10 years of the date of death. Now, again, there are some exceptions. So DJ, why don't you walk us through some of these exceptions?
Yeah, definitely. Always some exceptions, right? So a surviving spouse does not have to clear it in 10 years, and they can still basically suck it up into their own IRA like they previously could, and then they'd be subject to those same rules as if it was their own IRA the whole time. Children under the age of majority, so minor children or disabled and chronically ill beneficiaries are exempt from this. And lastly, beneficiaries that are not more than 10 years younger. So this would be like a sibling, right? You're leaving it to a brother or sister who's maybe 3 years younger than you. They do not have to clear it within 10 years. They can go off that life expectancy like it previously was.
All right, so what do we do? Well, the next webinar that we are going to have on May 11th, we are going to be talking about retirement planning considerations and some strategies in light of this new rule. And there are some things that we believe that you can do to really enhance that legacy and still pass on the assets in a tax efficient way. So stay tuned for that. You can find details on our website, and then also you will get a link to the replay of this, and there'll be invitations there to our next webinar. All right, the other thing I want to also highlight here is the required minimum distributions. Believe it or not, a lot of retirees do not like to take their required minimum distributions because it just adds to taxable income. Maybe they don't need the money for all different kinds of reasons. And so if you are a current client and you want to take advantage of the waiver for 2020 and not take your RMD, we again encourage you to reach out to us and let us know that you want to postpone that for 2020. And I also want to highlight another thing that DJ said was consider contributing, if you can, to an IRA. We have until July 15th of this year for 2019 contributions. And there's a lot of opportunity still to be had in these markets. Okay, so to kind of finish us up here, I wanted to bring us back kind of full circle to our process. So if you are familiar with our process, and you can probably see you're in the guided journey phase where you're coming back and getting more information. We love to lead with education. We want our clients to be empowered with this information. But if you're not a client, I would consider reaching out to us, allow us to do a discovery session with you, help you create a tailored solution that's unique to your situation, And then that guided journey is that ongoing client relationship that we are a fiduciary, we are helping you along this journey. LPL is our broker dealer. Again, as Chandran mentioned, they're the largest independent broker dealer in the United States. They have SIPC, which is Securities Investors Protection Corporation, which is important. If LPL were to fail, your money would be unaffected by that failure by SIPC. And then all of our wealth advisors hold our securities licenses and our registrations through LPL. The money is custodianed at LPL. And I wanted to touch on, again, our services. A lot of our customers come to us maybe through, they need to roll over a 401k, or they left a job and that needs to be rolled over, or they need help with a retirement plan, or maybe even college planning. So we have a lot of different services. So if you haven't been exposed to the different, our service menu, please head over to our website and you can learn more about our services that we offer to our clients. And if there's something that is intriguing you or that you need more information, just again, reach out to us and we're happy to help. And as we are kind of forced into this new format of providing information instead of in-person seminars, we're doing these webinars to stay connected. We would love to hear from you and get that feedback. So if you want to give us any feedback or have any questions, please email financial.freedom@lpl.com and we will be responsive to that, and I really appreciate the feedback we have been getting. It's encouraging because we don't get to see all your beautiful faces if we were live. So getting that feedback is important to us. So thank you for that. And then also, if you would like to schedule a virtual meeting, we are open for business and we are scheduling these meetings, whether by phone or we use a Zoom platform where we can virtually meet and see you. So again, if you would like that complimentary appointment, please reach out to us, or you can also give us a call there as well. And I think what we'll do is let me go to the next page and then we'll open it up for questions. So if you have any questions, please, oh, it's just the disclosure page. So there's the disclosure page. So
show that.
You gotta show that, yes. Why don't I go back so that way if anyone wants to write down our email or phone number, and then while we go into some Q&A here. So one question is real estate investment trust. So REITs, should I stay in or should I get out? Very good question. I think I'll start, I'll maybe give a little bit, and then if anyone else wants to jump in and chime in, that would be great. I think real estate lags stocks. So stocks are very forward-looking. They're very efficient, meaning they get information and it's put into the system right away, and they trade that very efficiently. Where real estate investment trusts, what is a real estate investment trust, I guess, would be number one for everyone that's listening on the call. Anyone want to explain that?
Yeah, I'll do it. So it's
okay.
A REIT think of it like a mutual fund for real estate. So you have a fund manager that goes out there, they buy a bunch of different properties, right? It could be healthcare, it could be just general commercial. There's all kinds of different ones. And then they rent those properties out to different tenants, right? A hospital wants to come in and rent their hospital building from them. They collect that rent and then they disperse that off into the, investors, the people that purchased into that REIT. So what's great about these is they don't move up and down with the market quite as much, the stock market. And so a lot of times when we go through bear markets, it could be a really great time to have some REITs because they may not drop quite as much as, say, if you owned a S&P 500 fund or something like that.
Yeah, thank you, DJ. And I would say that I would not, I would probably have to follow up with another question is, what type of REIT do you own? I would want to know, are the real estate that they are investing in, is it going to be jeopardized from what we are going through right now? You know, are they companies that will be getting these stimulus packages, and that I mean, it's stated in the PPP, the way that these loans can be forgiven for business owners is that the money goes to rent payments. And so that is typically a priority of a business, is to pay those rents. And so I would say that we kind of want to look under the hood and say, okay, what real estate does this REIT own? And do I feel comfortable in that outlook of that industry? So that is what I would err on. If it's ones that we have used in the past, they're very diversified. And so that I would say is more like stocks staying the course. Like, we will resume business. We will get, you know, things will go back to the way things were. Maybe not the exact same way, but anyhow, I hope that answered the question.
If I could add one thing on the REITs that we have provided, the non-public ones, one of the key tests is if they're still paying the dividends, and you're getting that 5 or 6 or 7% dividends, continue to get it during this market downturn, it feels better to hold on to it because that's a good source of income. Plus, if you try to liquidate prematurely, sometimes there's penalties and things like that doesn't make it financially viable to liquidate before that REIT itself is ready to liquidate.
Yeah, and that's a good point. I mean, when there's everyone saying, hey, I want to sell at the same time, and it's selling real estate, they're forced to fire sell it, right? And you don't get a good deal for your real estate if you have to sell it now to accommodate investors that want to get out. And right. So that is, and I also know of some real estate investment trusts that have elected to say, we don't know if we're going to have a problem. So they have suspended the dividend for 1 quarter to say, we don't want to have a run on this, but we have to prepare, because that would be a better case than the alternative. So those are some things that kind of come into play with real estate investment trusts. Thank you. Okay, so another question we have is, are you still in ELP with Dave Ramsey? So yes, although the ELP stands for Endorsed Local Provider. That was something that we started back in 2008. And then in 16? Help me, team.
Yes, 2016.
Okay, the program was kind of revamped, and now it's called SmartVestor Pro. So we are a SmartVestor Pro for the Dave Ramsey program, which just means that we are aligned with his philosophy. We are aligned with his thought process, with his baby steps, with that alignment. And it just makes so much sense, especially in situations like this. Any other comments? All right, so next question. If I have already filed my taxes for 2019, can I still invest in an IRA for 2019? Do I have to then file amendments to my taxes? So if you contribute to a traditional IRA for 2019, then you would want to amend your taxes, most likely because you would be getting tax money back because you get a deduction for contributing to a traditional IRA. A Roth IRA, on the other hand, because you don't get a tax deduction, it does not affect your taxes. That being said, when you do report on your taxes that you have contributed to your Roth IRA, that goes probably on page like 30 something, I don't know, but it gets added to your cost basis. And so it's telling the IRS, hey, yes, I have contributed to my Roth. I know it doesn't affect me tax-wise, but if you were to go and want to take the money out tax-free before 59 and a half, before 5 years, and get that money out without paying taxes, that's what the government looks to for your cost basis. So it may make sense to file an amendment to record that if you wanted to have that option to take the money out before 5 years, I guess would be the right way. Any other feedback on that?
Oh, you covered it.
All right. Well, oh my goodness, we've gone almost an hour here. So thanks for sticking with us. Yes, you guys have stayed with us strong. So we appreciate it. So mark your calendars, May 11th. We will be coming back on for another webinar. And again, we'd appreciate that feedback. If you want us to do a webinar about a specific topic, let us know. If you want to meet with one of our wealth advisors, reach out to us and we'll get that scheduled. Hope everyone has a good day.
Bye.
Bye.